The big question we always ask, looking into Asia and the impact from the US and quantitative easing and the debt, etc., and the China holding US Treasuries, is what really is the impact for equities, for earnings? You say the exports in your research, but is that the only impact?
I think that for earning impact, at least in the interim, that we are going to see actually earnings upgrade instead of downgrade for the whole index. There will be bad sectors like the shipping, like the machinery and equipment, especially under the China liquidity tightening. That being said, the bad kind of industries adding together could be just 10% or 15% of the index, but a major bracket, which is like the banks, oil, telecom, real estate, as well as consumers, those are doing very well. So I don't think that we are going to see earnings downgrade going forward too much.
I'm quite surprised because banks, some talk about the Chinese debt situation, not obviously as bad as the European or the US, but still, it is there, isn't it? So the banks, therefore, could be affected by that. And property, everyone discussed the bubble in Hong Kong or indeed in China itself, and you're saying earnings upgrades.
Yes. For the banks, I think that the way to look at it is that on the one side there are actually debt issues, especially related to the to saving the market after 2008. But on the other side, bank is also quite correlated with the economy. If we still see like 8%, 9% growth of the Chinese economy versus the world could be 0%, I think that the banks here shouldn't be too much traded down. On the other side, for the government debts, is government debts. On the other side, for the real estate, we are now seeing that the small guys are not doing anything. The large guys are doing much more than before. So the growth is actually on the large side. And this is also very, very good for industry consolidation going forward. So actually, if you look at the industries, there will be good guys, there will be bad guys, there will be losers, winners. But eventually, for the index, which represents those large guys, it's actually quite good.
Okay, let's talk about one guy, Joe Biden, in fact, just finishing off his Chinese tour. 3 days. He talked about growing pains in the US-China ties, and China has nothing to fear from its US Treasury investment, which currently is $1.17 trillion. Yes. Do you believe that there's nothing to fear? Do the Chinese now think, that's very reassuring, we're going to relax now? I don't think they're going to do that, are they?
I think eventually, you know, that the US controls the printing machines. So eventually, if there's always a way to pay, right? But on the other side, I think that it's a good kind of a check and balance for the US as well, because I think that the US need to think about how to potentially reduce the debt and make the economy more vivid. But on the other side, for China, there's also a lack of option. I think that Japanese yen or the Japanese bond is not an option. And the euro, we already see that. It could be even worse than the US dollars. So if China made itself a kind of reserve currency, or comparatively, they also need to take the reserve currency from the world, I think the US dollar will still be one of the must-to-have.
Interesting, you were saying that your research, again, the US non-farms jobs report is closely linked to the money supply in China.
Yeah, it is. For the money supply in China, I think that the most important driver is actually the export versus import, so the trade surplus. The second half of the year, I already said in the first half that we should see accelerated RMB appreciation, because now the RMB, if do not getting appreciated, then the trade surplus will cost China much more than potentially the U.S., because in China now the trade surplus is a direct way, or the most important way, of domestic excess liquidity. So I think that going forward with the RMB appreciates, on the other side with the domestic liquidity tightening from the banks, hopefully that the liquidity situation in China can get controlled, so the inflation can get controlled.
So overall, trades are slightly concerned, the exports impacting China, but China really is more or less independent of the U.S. earnings concern, because you said the upgrades are expected. Yes. If you were to pick one industry, John, which industry in China really does offer perhaps the best potential for the next earnings stage?
I actually picked 5 industries in the report. I think there was some kind of conventional wisdom.
Pick one of the 5 that you think it really is too hard.
The most offbeat one, I will pick the real estate.
Right, which is extraordinary, isn't it, when you think about the concerns facing the bubble, etc.
Exactly. I think that real estate, a lot of people actually argue about it because of the political headwinds. But on the other side, if you look at the real estate, earnings are very robust, and on the other side, the valuation has been quite low. And on the other side, the final thing is that the real estate actually the #1 consumer sector in China. If you look at that and compare the 6, 7 times real estate growing at 50% of the earnings versus the other, like the consumer sector trading at 30 times, growing at 15%, I think that's to me, it's a no-brainer. The only thing is that if we just look through the short-term political headwinds and looking more into a longer term, as long as the urbanization is going there, I don't think that the real estate should be traded at this level.